Hello again, and welcome to A Few Minutes with Marcia. My name is Marcia Clark. I'm the Senior Research Analyst for Warren Street Wealth Advisors, and today we're going to talk a little bit about monetary policy, negative interest rates, and whether the cure is killing the patient. My comments today are inspired by an article written in August 2019 by Michael Arone at State Street Global Advisors, and I really think you should check it out. There's a link at the end of this presentation. Let's begin with a refresher on monetary policy. There are two basic approaches, the supply side approach and the demand side approach. The supply side is trying to match the level of money in an economy with the degree of transactions that are desirable and appropriate. The demand side is trying to match the demand for funds with the degree of transactions which are desirable and appropriate. For a long time, the Fed was focused on the supply side of this equation, until the late 1970s, when Paul Volcker, the chairman of the Fed at the time, cranked up those short-term interest rates to fight inflation. Since that time, we've shifted a little bit toward more on the demand side. But how does this work? If an economy is struggling, reducing interest rates should encourage businesses and consumers to borrow money, and then they can hire more people or buy more things and take more vacations, which should stimulate the economy. On the flip side of that, if the interest rates are high, then businesses and consumers should borrow less, buy less, and then that will slow down the economy. So how does that work? Pretty well, actually. If you look at the chart on slide 5, you can see that we have economic activity over here. We've got Fed funds rate, we've got inflation, and we've got employment. So this is what we're looking at. Here is inflation, the green line is employment, and the Fed funds rate is over here. So we're looking at these booms and busts, it represented by inflation in this chart, and you can see that the spikes were pretty dramatic back in the day. But after Paul Volcker started cranking up those rates to fight off inflation, we did end up with a couple of recessions back to back, but also from that time forward, we entered this new era where those booms and busts were just not quite as dramatic as they used to be. You can also see in this chart that the current level of Fed funds rate is actually very low. Even though the Fed has raised interest rates, they're still quite a bit below where they've been historically. Well, how does this work? How does changing short-term interest rates, which is the only rate the Fed really controls, affect long-term interest rates? Well, the Fed funds rate and the discount rate that the banks can borrow from the Fed set a foundation that the banks use then to apply a spread to decide how much interest rate they will pay us on our deposits and CDs and how much they will charge us for car loans, house loans, credit cards, that sort of thing. So the theory is there's a domino impact. If I change short-term rates, then those longer-term rates should change as well. Now, what about negative interest rates? Well, negative interest rates are going just one step further. The central bank charges its member banks to keep money on reserves. So if the bank has capital and wants to keep it because they're a little bit nervous about the economy, they actually have to pay a penalty to the central bank to keep that money on the sidelines. And the idea is that those negative rates then would give an incentive to the banks to lend money that otherwise they would just keep in their accounts and keep it safe. Now, does it work? Does it not work? Well, there's no real evidence to show that it works. You can look at Japan, that's had negative or very low rates for years, and Europe, who's had them for the last year or so, and still those economies are floundering. So we're not sure that it works, and we're actually not even clear that the downside risk is worth it. And let's talk a little bit about that. Downsides include unintended consequences of speculators borrowing when they shouldn't borrow, that the savings rates paid to you and I, if we're relying on interest to pay our bills, is not quite what we need them to be. There also might be a productivity losses from less lending than should be productive lending, and there's maybe even a wealth gap between where the rich people can take a little bit more risk and get some money, but the poorer people, those who just rely on savings, they don't get what they need to keep ahead of the game. So there's a lot of downsides to negative rates, And like I say, the jury's still out on whether the upside is really working. Now, another argument that we hear about why these interest rates in the U.S. should be lower than they are right now is this competitive advantage. U.S. rates are a lot higher than interest rates in other developed countries. That's because our economy is doing better than Europe and other developed markets, so we can have these higher rates. Well, should we be more competitive? And the Fed referred to this as they reduced rates again in September. Well, the interest rate parity theory of macroeconomics would state that if you do have higher rates than other people, then foreigners will exchange their currency into your currency, buy your securities so that they can get your higher rates. And this buying and selling of currency will affect the exchange rate, which then would affect the cost of our imports and exports to other countries, which then could impact our economy. So there are reasons, again, to be closer to each other as far as interest rate parity goes, but still we're not really sure that that's a result that's worth the impact domestically. Well, inflation is low. Our rates are higher than other countries. We could go for it. We could keep cutting rates. We could get all the way down to zero. But actually, what disease are we trying to protect ourselves against? The economy is actually pretty good. As you see from the stats on the chart, GDP is running 2%, 2.5%, which isn't stellar, but it's fine. Wages are finally beginning to grow. Unemployment is at 50-year lows. Inflation's about where the Fed wants it. So it's almost as if there's calls for the Fed to solve a problem that doesn't really exist. And the other downside for monetary policy we really want to think about is, have they done enough, or how will they know when they've done enough? There is a lag between changing these interest rates and seeing the impact in the economy. If the Fed cuts rates too much, they could use up all their powder for when we actually do enter a recession. And if they don't cut enough, of course, maybe the economy will enter a recession faster than we expect. So it's a delicate balancing act they're trying to manage, and we think they're doing a pretty good job, but continuing to cut rates from here just seems a little bit too much. So are negative interest rates good or bad? Is the Fed doing a good job, not doing a good job? It's really hard to say, but we can say right now that the U.S. economy is okay. Global economies are suffering mostly from trade tensions and political unrest, and reducing interest rates further is probably not going to help that. So our recommendation is for the Fed to hold tight. Let's wait a little while, see how these rates are impacting us over the coming months, and then decide if more medicine is needed. So that's been a few minutes with Marcia. I hope you know a little bit more about monetary policy and how those interest rates work, and we'll talk again soon.